Hi, I'm Strydom, Portfolio Manager at Citadel. Today I want to talk about listed property as part of a multi-asset portfolio. Some people believe that the property cycle is at its end and you should not invest in listed property at the moment. This point of view highlights a certain mindset about property which I will try and address today. A good starting point is it a good time to invest in bonds or equity? Bond yields have moved up recently but remains close to historical lows, and interest rates are yet to start normalizing. So it is probably not a good time to hold bonds. The JSE price earnings ratio is close to an historic high, and many market commentators say it is very expensive. So it is arguably also not a good time to hold equity. But the fact is that most multi-asset portfolios continue to hold both. Why? Because both are permanent building blocks in a long-term multi-asset portfolio. And we need to start thinking about listed property in a similar way. That is an important part of a well-diversified portfolio seeking to deliver real returns. Returning to the opinion that it is the end of the property cycle, there are two factors that we need to consider. Interest rates are set to normalize and property fundamentals are deteriorating. The impact of rising interest rates are both direct and indirect. Property companies will pay more to service their debt, which has a direct impact on the bottom line. However, most companies have fixed their debt at current low levels and have taken advantage of this. So for a number of years, the direct impact should be muted. The indirect impact is that shorter-term higher rates will cause bond yields to rise. Historically, there has been a strong correlation where bond yields have risen, property yields have fallen. However, an increase in the short rate does not guarantee yields will rise, especially if long-term inflation expectations remain firmly anchored as they are at the moment. The final point is the magnitude and length of the interest rate hiking cycle. This, however, determines not the fate of only listed property, but all asset classes too. Evidence of the effect of rising interest rates on listed property performance can be drawn from the history of the United States market. There has been 7 rate hiking cycles since 1972, and property produced a positive return in 5 of these, while only falling in 2. So while rate normalization is sure to cause volatility, it is not certain to cause prices to collapse, and we believe that property fundamentals and the economic environment are more important driving forces longer term. Turning to property fundamentals, we believe that the outlook remains sound in South Africa and strong in most of the developed world. The South African economy remains sluggish, and there are pockets of oversupply like offices in Sandton. However, vacancies overall remain below historical averages and rental escalations ahead of inflation. Our listed property companies are very well run with high quality real estate portfolios. Most companies also have offshore exposure where fundamentals are better than locally. Globally, economic activity is picking up and demand for property is increasing. There has been very little supply coming onto the market in the last number of years, creating a supportive environment for vacancies and rental growth. Central banks remain accommodative in Europe and in the East, and the United States economy continues to improve. We're optimistic about the outlook for global real estate. In conclusion, given the prevailing market sentiment, it certainly won't be smooth sailing as we move closer to the point of interest rate normalization. Nevertheless, and regardless of short-term volatility, listed property remains an integral part of a multi-asset portfolio, and its defensive income-generating nature can produce attractive total returns, that is, income and capital growth. And it can do this across a variety of economic scenarios. Thank you, and goodbye.